Hello and welcome to episode 521 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy, and last week we had a bit of a break from the heavy topics like investing. So this week on the podcast, we're going to do something that's very much investment focused. It's going to be a bit of a special, and it's really a celebration of the 50k portfolio that I've been running, which is just about to turn into £100,000. So I always refer to this as the £50,000 portfolio that I run live on 80/20 Investor. Very soon, I probably need to just change how I refer to it and call it the 100k portfolio. And I've been doing it for more than a decade now, and I don't know anybody else out there that runs a portfolio live or has run one for 10 years to prove the investment process that they use actually has merits and works in the real world. There's lots of people out there that talk theory about how to invest, but this is putting things in practice, which is why I started it back in 2015. So we're over 10 years of running 80/20 Investor in my portfolio, and like I say, we've nearly doubled the portfolio to £100,000. And what actually happened is the last portfolio review I did for 80/20 Investor members was about a week ago, and Justin always double checks the articles and the emails before I send them out. And he turned around and said to me, and for those of you who don't know, Justin is my twin and one of the other directors in Money to the Masses. So he was checking the content of the article just to make sure there's no errors in there. And he turned around and said to me, why the hell do you not shout about this? Because you're absolutely smashing it. And so in true sing when you're winning, and I mean, I have been winning for the decade that I've been doing it, but at the moment we are hitting new all-time highs on the portfolio. And I thought, do you know what? You and I, Andy, don't talk enough about things like the podcast. We're a little bit too modest and try and promote it. We hope things happen by osmosis. We don't talk enough about things like 80/20 Investor in great detail, or even the money. So our new AI financial guidance engine, it's been on the podcast, but we do just mention it from time to time. So we do need to talk about these things a little bit more. But what I want to do today is talk about my portfolio over the last 10 years, but importantly, the journey and the lessons that I've learned. And there will be some takeaways for people out there who maybe aren't interested in 80/20 Investor, which teaches people how to run their own money themselves. So it teaches you how to invest your own money. So my background was a person who used to build portfolios for very wealthy people. So I'm into picking investment funds, for example, unit trusts, ETFs, investment trusts, and building portfolios. And I used to appear in the national press, and I still do from time to time, talking about investing. And that expertise I put into 80/20 Investor. So I do research articles, a weekly newsletter, and I run a portfolio as well. So what I want to do is bring some of that to the podcast. So you may listen to this and think, I want to try 80/20 Investor. Well, you can take out a free trial. We'll talk more about that later. But also, I want to give people some insights that they can take away, and maybe they might look at the way they run their own money, their own investment process, and see whether it tallies up or whether it's different. So that's what we're going to be talking about today, Andy. A bit of a special, teaching people how I run my own money.
Okay, so it's a bit of an investment special this week, Dane. You're going to be looking at that 50k portfolio, or what we should probably now call the 100k portfolio, and that crazy journey it's had over the last 10 years, where, of course, we've had things like the pandemic, and we've also had the US trade war with China, all sorts of things going on. But before you go on to that, if you just rewind a little bit, I think it's worth explaining to listeners what 80/20 Investor is.
Yeah, so 80/20 Investor was the service that I built to help people run their own money. So if you go back to 2015, there really wasn't any service out there that taught people how to pick funds. Because let's be honest, when you're going to run your own money, you might want to pick shares, but that is a very high risk strategy because a lot of people will put all their money into very few baskets. Whereas if you buy funds, for example, which are run by fund managers, or they may even be passive investments that track whole indices, then what you do is you spread that risk. You're not investing in one company, you're investing in a whole basket of companies within a fund, and then you might choose a number of funds, which helps diversify your portfolio even more. But people don't know how to choose them. So I wanted to bring the professional experience that I had from my career into the retail space to allow people to use that knowledge and expertise and teach them how they can research their own funds and build portfolios themselves confidently. On top of that, I used a screening method which was based upon momentum but had a risk overlay. So it didn't just look at price momentum, which means that you're looking for trends of things that do well on the assumption that they tend to do well going into the future for a period of time. So there are three real styles of investing that have been proven over the long term to outperform, and that's investing in smaller companies. So those are smaller companies that might turn into tomorrow's bigger companies. Value investing, where you pick undervalued companies, so companies the market might not particularly like for some reason, but there's something in them that the market has perhaps mispriced, and you then buy them, and then the market at some point realizes that the company is attractive for whatever reason, then the share price will rise, and in you having bought them when they're undervalued, then make a healthy profit. So that is what Warren Buffett, who's probably the most famous investor in the world, that's the style of investing that he chooses. And then you have momentum investing, where you invest in things that are tending to rise in value over a given period of time. So you're riding the momentum upwards. Of course, you can ride it downwards as well, but you're trying to invest in a trend that's unfolding. So those three styles have been shown over the long term to be styles that do outperform. So I used the momentum idea and baked that into an algorithm that will screen all the funds out there and then put a risk overlay as well on it that identifies funds that have momentum at this given moment in time. And the idea being that you may then look at them, do your own research, perhaps invest in a fund that has momentum, which hopefully, and there's no guarantee of this, continue with that momentum, hopefully higher. So what people see when they use 80/20 Investor is, first of all, some data tables which have a short list of funds on there from various different sectors covering a variety of different asset classes. There are also research articles where I research particular topics. Maybe, for example, it might be to do with emerging markets. It could be funds for Brexit. If you remember, Brexit happened during the period that I've been running my portfolio as well. And it might identify funds that could potentially do well or badly given certain environments. Maybe it's high inflation, for example. And so putting that all in the round, it gives people access to what would be an investment expert, which is me, but in a very simple, succinct way online. So with all that said, the service was aimed at allowing people to pick their own portfolios and make informed decisions themselves. It's their decision, what they want to pick. This isn't advice. So what I did is decided to run a portfolio using the information that's published to highlight to people how to use the service, but also to show that you can use it to successfully invest. So this is where the 50k portfolio came from. I put £50,000 of real money into investments, and then I run those investments, reviewing the portfolio every month, showing people what I change or what I might not, and then I give them reasons for it, and then publish that each month. So there is a live portfolio on the site that people can see where I'm investing my own money. Now, we're going to show on screen a chart, and that chart shows my 50k portfolio over the last 10 plus years versus a benchmark and versus a second benchmark, which is titled the Average Managed Multi-Asset Fund. Now, in a minute, I will tell you about some of the changes to my portfolio over time, but what that benchmark, the first one you see, which is a red one, shows you what an equivalent portfolio with the same asset mix, so the same percentage of exposure to maybe UK equities or European equities at a given time would have done. So the difference between the red line and the green line is the actual funds that I picked that drove that performance, while the blue line that you see on screen shows you what the average multi-asset fund manager, so the professional fund managers out there that had a similar asset mix to me at the time, would have achieved. So for those who were just listening to this, my portfolio is up 97%, just over. The benchmark that I've used to replicate what would have happened if somebody had replicated the asset mix of my portfolio, but they had an average return from a fund within a given sector, let's say it was UK equities, that shows you that performance was 69.91% since March 2015, and then the average managed multi-asset benchmark was at 58.38%. So you can see there's a significant outperformance, which I'm incredibly proud of. The next chart I'm going to show and talk about is the performance versus the well-known sectors for multi-asset managed funds out there. Now on screen, I've just flicked across to another chart, which is my portfolio again. It's up 97%, just over, against the mixed investment 40 to 85% shares sector. So the average fund within that sector. So those funds typically have, as the name suggests, between 40% equity and 85% equity. So my portfolio has varied over time, the amount of equity content. At the moment, it has about 64% equity. That's kind of typical. Around about the 60% mark is typical for my portfolio, but it has been quite a range. Now that average for the sector is 75.96% over the same period of time. So my portfolio is more than 21% above that for the sector average. The next sector I show is the 20 to 60% share sector. So that's the multi-asset professionally run funds with 20 to 60% equity exposure. They've returned just 46.24% over the 10-year period. Now that's a massive difference. And the reason I picked those is because my portfolio typically would lie in terms of equity exposure somewhere between those two sectors, because a lot of funds within that 40 to 85% share sector will have actually 85% equity. Now the thing is, over the long run, the more equity exposure that you have, the better you should do. So that's because of the risk that you are taking. Now, just to finish this point, if you took all the funds within the 40 to 85% share sector, so that mixed investment sector, which are the professionally managed multi-asset funds, if my fund lived in that and I was a fund manager, then as a ranking, it would be 26th out of 142 funds for the entire period that I've run this portfolio. Now, all of those funds that are above mine have more equity exposure, and I'm incredibly proud of that, because it means that as somebody who is teaching people how to run money, that I have outperformed fund managers that have over £70 billion worth of investors' money within their funds. So they're running that amount of money for UK investors. And I'm just showing you that armchair investors can outperform professionally run funds. They can run their own money just as successfully. You've got to bear in mind that my portfolio is live, so I'm running it using an ordinary platform. I don't benefit from the economies of scale that fund managers do, who can drive down the charges that they have on their fund, and therefore that helps their performance. I'm paying the price that everybody pays. Now, that includes funds that I've outperformed, including the Vanguard Life Strategy Fund. So, for example, like the 60% equity version of it. And as I've mentioned, there are only 25 funds that have outperformed mine, and they are the ones that have much higher equity exposure. But that's what's important when you're looking at performance, and it's for you as well when you listen to this. If you ever manage your own portfolios, just because you've outperformed doesn't mean that you have done it in a way that's responsible. It's a bit like somebody driving in a race. If they're just going completely erratic and almost crashing the car, the idea is it's about risk management. You're going to get there and actually make it to the end of the race. So in my portfolio's case, it's been about risk management. So we can look at measures of performance. So alpha, for example, is a statistical measure that measures skill effectively of a manager. I'm looking at it here. I would be ranked 27th out of all the fund managers in that sector for that particular benchmark. We've done return, but if you looked at Sharpe, so Sharpe ratio measures the return you get for the excess risk that you're taking. So in terms of Sharpe, I'd be ranked 28th. So I'm actually getting a really good return for the risk that I'm taking. Sortino is another type of measure, very similar, but it's more about managing drawdowns. And so in that regard, I'd be 19th in the sector. All of these put me in the top quartile as a fund manager. And in terms of volatility, I'd be ranked 19th. So when I talk about volatility, the ranking is the lower volatility. So I have a much lower volatility, the ups and downs of a portfolio compared to all of those other professional fund managers. Now, this isn't just me sort of backslapping saying how clever am I. This is me showing people that if you follow a process over the long term and you stick to it objectively, which I'm going to talk about in a minute, is quite difficult sometimes, but if you have a process and you stick to it, then you can outperform and not just get better performance, but performance that is risk managed as well. So you are doing it in a responsible way. Now, one thing you've got to bear in mind, that if you go back to 2015, when I started this exercise, then I could have picked any fund to invest in. So I based my portfolio on the 80/20 investor process and the algorithm and the funds shortlist that were available at that time. And you have to bear in mind that you could go and pick any of the funds. So I said I was 26th if I was in a ranking, for example, in that sector. So you could say I could pick one of the other 25, for example, and I would have beaten you. But you didn't know that back then. You didn't know which funds were going to be the best performers. You didn't know what was going to happen over the next 10 years. What I did was follow a process where I was regularly reviewing a portfolio, making changes and objectively looking at it. So mine's a reflection of a process and not just a reflection of pot luck. So somebody could have picked a fund within the sector that had a very high equity exposure and they could have said, well, I would have outperformed, but you didn't know that we weren't going to have a dot-com bubble burst or something similar, black swan event, that made your portfolio plummet massively. So mine was about risk management. And one thing I wanted with 80/20 investor, you have to remember, I ran this portfolio based upon it had to be very middle of the road in terms of risk. If it was mine personally, I would have taken much more risk. And the idea of 80/20 investor is that people can choose what they want to do. It gives them information that they can use to make their own informed decisions. So they could build much higher risk portfolios based upon momentum. And of course, there are risks with that, and no returns are guaranteed in any way. But it does mean that this isn't a singular outcome. So if you'd have picked a fund 10 years ago, a random fund that you would have gone, this multi-asset fund, I believe in the manager, and you would have bought that fund, then you don't know. You've got one outcome that's going to happen because it's how that manager does over that time. The thing with the 80/20 investor service was always that if you had thousands of people using it, they could potentially have thousands of different outcomes based upon the process. So that was the idea. And I'm ecstatic that we achieved that and the returns, but more importantly, teaching people how to risk manage. So what I want to do now is talk about some of the lessons that I learned from running a portfolio in the real world live, because we had some monumental events that happened. I mean, we had some huge things like Brexit. We had the pandemic, like you mentioned, Andy. We've had 2 Donald Trump presidencies with the tariff trade wars. We've had a tech slump. We've had wars in Ukraine. So there's a whole host of things you can talk about. And even within the fund management industry, there were some crazy things that went on, like, for example, Neil Woodford's fund collapse. Just navigating all of these things that happen that 80/20 was all about. And I'm going to talk about some of the things that I've learned. But before I do that, I just want to give some insights into how my portfolio was constructed. So I explained the process. I'm not going to tell you exactly how the algorithm works at 80/20 investor. You can take out a free trial if you want to look at the fund shortlist. But over that time, I analysed all of the transactions that I made during that period. And as I mentioned, they're always published at the time that I make them to keep it objective and transparent. But typically, I never held more than 2 funds per sector ever in my portfolio. So it didn't mean that I didn't ever get to 3, but typically I wouldn't say, for example, have more than 2 global equity income funds, because beyond that, and there was research that I carried out showed that once you get above, say, 3 funds from the same sector, then the performance starts to morph more towards the sector average, and you're looking for performance that's going to be better than average. So that is one of the things that people could take away. Now, over the whole time I've run the portfolio, I made over 180 fund switches, and we're talking over 10.5 years. So that might sound quite a bit, but when you look at it, it means that I typically only made 1 fund change a month. So it was just under 1.5, if you're going to be pedantic, 1.4 fund changes a month. So realistically, what that meant is every month I look at my portfolio and see how it does. And I will make small tweaks. It's more like pruning a garden than digging it up every time. So I might reduce a holding, or I might increase one, or I might completely take one out or add a new one. And it means that the average time that I held a fund was around about 10 to 11 months. So there will be some that I only hold for a very short period of time. Interestingly, the longest fund I ever held was for over 3 years. And that fund last month was taken out of the portfolio, and it was actually a low risk absolute return fund. So for people that are interested, it was the Premier Miton Tellworth UK Select Fund. You wouldn't hear much about it in the press or anything like that, but it had incredible performance during some of the biggest downturns we've ever seen, and it was very good at preserving capital and grew over time. But in the last few months, it's had a little bit of a lag in performance, and coincidentally, it has been bought out by another fund house. So that might not have anything to do with it at all, but just at the moment, the performance has actually lagged. Now, one thing I would always say to people is that I never, ever, when I looked at a fund and changed it, considered the price I bought it at and whether I made a profit or a loss. That didn't enter my viewpoint, my decision making, because what I did was always just objectively look at whether there was a better opportunity than the one I had. And on the podcast, I've mentioned in the past that you should try and look at things with fresh eyes and say, given the information that I have today, would I own that particular stock or fund? And if not, then it's time to remove it or reduce your exposure. That's what I do all the time with 80/20 Investor. With my portfolio, I'm using objective data to make the assessment, and it forces you into the more difficult decisions that you probably wouldn't make naturally. So you've got to remember, we're really bad at investing as humans naturally. So what I'm talking about here is something called anchoring, where you look at a price, for example, that you bought a fund at maybe, and that is an anchor at which you make decisions based around. So you judge the sort of success or failure of a fund based around that particular price. But I don't do that. So therefore, I sell funds at a loss. I sell them at a profit. Hopefully, what happens, and it's proven, if you get more decisions right than wrong and you ride those winners for longer than you do the losers, then you will hopefully outperform over the long term, which is exactly what I've done. So that is one of the typical things with the portfolio, is I make objective assessments every month. Another interesting stat is that the highest equity exposure I ever had was 68% in the portfolio. The lowest was 28%. And the highest cash position I ever had in the portfolio was 23%. And that was back in August 2018. So that shows you that it's quite a dynamic portfolio. I do change it, but as time's gone on, I tend to keep it nearer that 60% equity exposure over the long run, just to give it that balanced risk profile. Now, one of the lessons of running a portfolio over time is you do look at how assets performed. And I never had gold as a significant holding within my portfolio. And it's since July 2020, I carried out a piece of research that looked at gold and its impact on portfolios and diversification. And it came to the conclusion that holding gold did help with diversification, as long as we didn't hold more than, say, 10% in the portfolio. So my portfolio has a fixed allocation of 5%. It does increase if gold rallies like it has this year, of 5% investment in a gold ETF that is permanent. And that has had huge positive impact on my portfolio, especially in the last couple of years. And don't forget, gold has rallied 40% year to date. So that has had a positive impact on the portfolio. So that is the sort of thing that over time, when you're running a portfolio, you carry out research, you start to learn and you implement. Now, going back to Brexit, that was an interesting time with the portfolio. It's very early on, in fact. And one of the things that I learned from that was the massive impact that currency moves can have. And so it's always to be mindful of the currency move, because when we had Brexit, obviously the pound tumbled and the portfolio got a massive boost, as did a lot of other funds, because of the outcome of Brexit. With the pound fell, and if you had overseas assets, it boosted those. The other thing that investing during that period, which was really insightful, there were, at least one robo-advisor that was launching around that time and held off investing ahead of that event. And in fact, Brexit gave portfolios a massive boost, and they took years. I'm not even sure, I haven't looked to see where they really caught up from that big kicker, because overnight the portfolio, for example, leapt, I think, more than 5 or 6% in a single day because of Brexit. And it just goes to show with certain events where the consensus was at that time that we would remain, it generally was in London anyway, and the outcome is never certain how markets will react. And so by investing through an event and not listening to what was going on in the press about how you should adjust your portfolio, it showed you didn't necessarily need to predict what was going to happen because you were going to inevitably be probably wrong. And that was a very early lesson when managing money publicly, of how by not trying to predict what happened and just to follow a process, that I benefited massively from that. Now, I remember the pandemic, and obviously the portfolio, like other portfolios, were falling because the world was shutting down and no one knew what was going to happen. And you have to remember, when we go back to the pandemic, it was a really interesting time because we really didn't know what the future was going to look like for everyone. I know people will kind of rewrite history and say, oh, I knew we weren't going to be locked down forever and all this kind of stuff. Objectively, that really wasn't true. You could guess that might happen, but we were in the midst of everything being shut down and we really didn't know what was going to happen. And of course, investment markets, therefore, just collapsed. And trying to invest through that process was very difficult because you're seeing falls of double digits happening in days. And during that, I mean, there was no way I could have foreseen what was going to happen. And you had to come to terms with that. But investing through that period did teach you quite a lot. And it was about the shortness of some of these progressive sells, because it was the quickest bear market we'd ever seen. And when things get very oversold, they tend to rebound. And during that period, I did move into like gilts and some bonds, and increased the exposure to that, which was to the positive of the portfolio, but that was quite short-lived. And then we had a massive rebound in the market, and I slightly missed out on some of that as a result. And so one of the things that I learned from that period is that, yes, you can get caught out by these sudden crashes, but you can from the rebound. And there are periods where you should perhaps be a little bit more patient. And I've done a lot of research around that, prior and subsequent. And I've embedded that more and more into the portfolio, especially when it comes to the trade tariff or trade war with Donald Trump. And during that period, there was a lot of people who were panicking, but you can take a step back objectively. If you look at the research, I carried out lots of research into what to do during downturns to see that the best days often come very close to some of the worst days in investment markets. So seeing that in action, seeing it unfold while you're actually investing, does make you very thick-skinned going forward. And it's very good at showing you to rely on the research that you carry out, because in the panic, it can be very easy to just sort of think, no, I'm just going to bail out fully into cash, which a lot of people did. So that was a great lesson during that period of how to deal with very uncertain times, black swans, and heavy losses. The other thing, I think we had an inflation spike in 2022. That was quite a tricky period. And we saw bonds do very badly. And again, sticking to the process, moving into other assets. I mean, gold was a great diversifier. And you've realized that no style wins forever. And again, sticking to the process, but it reinforces some of the things that you are trying to implement, that you sometimes have to make uncomfortable decisions about things and invest in things that you perhaps weren't keen on doing, but it's based upon your process. So during that period, for example, we're moving out of bonds, so some of the low risk assets, into other types of investments. And that is something that can be quite difficult to do emotionally, because you want to have an anchor of some bonds in a portfolio, but the reality is they're not diversifying. You have to make those decisions. The other one more recently was coming into this year was I started to reduce exposure to tech stocks, and we'd seen tech do really well. It was the winners in terms of leading the market higher. But again, there comes a point when you start to see other areas start to outperform, and that's versus, say, the stuff you already hold, in this case, technology stocks. I started to allocate money elsewhere. And so what I was doing really was locking in profits. But it can be a case that you want to hold on to winners for way too long, and you start to become emotionally attached to them. So again, by sticking to a process, it helped me lock in profits sometimes and move elsewhere, and to look at a portfolio and then revisit it. And if certain areas are becoming overexposed in the portfolio, then to make adjustments. So what I want to really summarize is to say to people is that there are going to be decisions that you make that are uncomfortable, ones that are going to feel right that go wrong, ones you feel that are wrong that go right. But it's, as long as you've got a process, there will be periods where you do make decisions that mean you start to lag the market maybe. But if you stick to the process, there'll be a period where you will start to outperform. So you won't outperform all of the time. So early 2019 was an example where I was slightly slow getting back into the market, but that is when you get a sudden shift in momentum. You can be on the wrong side of it if you've made a decision to effectively back the wrong horse. That's going to happen from time to time, but with a long enough time frame, you start to see that if you keep going with the process, then you should hopefully, in a long enough time frame, start to outperform. And that's just a general thing, whether you are an active investor or passive investor. Being a long-term investor is where you make the money. So you can grow wealth over time. It's getting rich slowly, effectively, and then that can compound. And when you start compounding, your outperformance compounds as well. The other thing I just want to mention before we finish is some of the biases. I mentioned anchoring. That was a key thing of not being focused on what I buy and sell funds at. That stopped that anchoring. The other one is endowment bias, where you favor things you hold. Now, the example that I said about the fund that I sold just last month, that fund has been in my portfolio for 3 years. It's the longest a fund has been in my portfolio by some margin. And it's been the best performing portfolio, or fund, I should say, at the low risk end of my portfolio. So actually getting rid of it emotionally feels a little bit difficult, because you can look at charts and it's been an incredible performer through some really difficult periods of time. But I had to take the objective decision that I felt, well, there may be better options available now. It's not to say that that fund is bad. And that's the other thing to bear in mind. When I move funds out of a portfolio, it doesn't mean I think they're no good. It means that I think there might be a better opportunity elsewhere. And sometimes you get it right and sometimes you don't get it right. So all the time, all I'm trying to do is conquer those biases that make us inherently bad investors. And I suppose the message is for anybody out there is that you can run your own money. I think people want to do it and try and learn what they're doing, even with a small amount of money. Even if you have a core holding of passive investments, it still means that you can do something on the outside. It's your money after all. And so I think the other thing I would say is that I never predict what's going to happen going forward. And I don't try and second guess what markets are going to do. I'm just aware of what markets are doing, and you can overlay some of that onto your decision making. But I try not to, because if you focus on the objective data, then I think it means you stop using those sort of biases that you have. So I'd like to think I've given people lots of insights. In the previous podcast, I actually talked about my asset mix. I think that was 2 weeks ago, and where I'm invested at the moment. There are lots of tools and, as I say, research articles on 80/20 Investor. So please, if you find this interesting, do go and have a look. It may not be your thing. You could take out a free trial and cancel after a month and it won't cost you anything. You can find out all the details. We'll put a link in the show notes. It's a service that we've been running for over 10 years, but we just don't talk about it enough. And it's, I think, in this world where we have got lots of amazing services, whether it's robo-advice services, whether it's passive investments that you have, that all have their place. But there are people out there that do want to try and manage their own investments and do something a little bit different. Then this could be something that they might find interesting and teach them along the way, because of all the weekly newsletters, monthly newsletters as well that I publish, with the aim of trying to teach you how markets work and link up all the things that you hear about in the normal press, investment press, with what's going on in your portfolio. So we'll put a link to that in the show notes. Do go and have a look. If you find it interesting, then do go and have a look at 80/20 Investor.
Okay, so that's it. We're nearly at the end of this podcast. It was an investment special where we're looking at Damien's 50k portfolio. Actually, I've got a question on that, Damien, because I've been looking at you run that portfolio for over 10 years, 5 of which, at least, I've been working at Money to the Masses, and I see at first hand the work that goes into it. Do you ever find it sort of super stressful because you're doing it on a very public platform? You can't really, or you haven't got much wiggle room for making mistakes. And if you do, there certainly are going to be quite embarrassing.
Yeah, do you know what, Andy? I think it's a good question, because I found it very stressful in terms of heavy the responsibility, because anything we do, I feel very responsible when we're talking about anything on the podcast. So we always try to make things perfect, and that's always a route to sort of sometimes a bit of stress, being a perfectionist about things. And so it does concern me that people do look at things. As much as I might say to them, don't copy what I do, I have to be mindful that people are grown adults. They can make their own decisions about what they ultimately do. So I had to try and create something that was a portfolio that people could see, that was like, well, yeah, show me the proof is in the pudding type of thing. But equally, doing it publicly was something that could have gone wrong, for want of a better phrase, because if you're saying that this is an investment process that should work based upon something like momentum investing, which the long-term research has shown should perform well over the long term, all these things are great when they're in like almost in the lab, when people are pulling them apart and running numbers and stuff. When people actually do it in the real world, very few people ever do anything like that. So they come up with these ideas that you how to grow your wealth. So I did find it quite heavy, to be honest, for years. And then as time went on, and particularly during periods where we had some very aggressive sell-offs, and you don't know where the bottom is. But then over time, when you're doing these things, and this is a lesson for all investors, the longer you do it, the more comfortable you become with what's going on, because you've seen it all. And I remember writing on a newsletter before, and I do it every year pretty much. I congratulate everybody who is an 80/20 investor member, saying like, enjoy your Christmas and well done on another year of running your own money through, particularly when we had the pandemic, the most difficult year on record. And we had a year a couple of years ago where it was the worst year for like a 60/40 portfolio, like a bond equity portfolio. And the fact that you can make money in that environment as well shows just how well you're doing. And that was one of those things that people have to sit back and look at. And I'm the same, where you have to go, look, the world can throw some crazy things at you, but the longer you do it, the more you've seen of it. And you almost get to the point that nothing can surprise you. We're going to have another financial crisis. It's a fact. We're going to have major black swan events. But when you've gone through them, you're kind of, battle hardened. And you therefore realize that, yeah, this is the process and I can cope with it. And therefore I never have sleepless nights now. I don't even look at it. I don't even do you mean I don't check the portfolio all the time? In the early days, I would have checked it more to be like objective to see what's going on. Now I wouldn't even look at it until between portfolio reviews. So it just shows people that's what happens the longer that you do things, run your own money, invest, because as a long-term investor, you start to see the nuances aren't important, like the day-to-day moves. And even you get to the point where you've got week-to-week and month-to-month moves and year-to-year ones, because if you've got a process and you can see that it's working, whatever your process is, then you should be comfortable. Even if you're just investing in a passive tracker and you're putting money in, you start to ride the ups and downs of markets. You start to realize that they are part of the fun, the journey. It's like trying to learn to surf and not wanting to get wet. You are going to get wet, and that is part of it. And you realize that they just make you a better investor. It means you've seen and you start reacting less and less. So I think it's a good question, because I'm not going to lie. In the early days that I did it, I found it quite a heavy responsibility and burden, and I have done over periods of time. But now I'm much more, after doing it for 10 years, I feel like I've proven something, if that makes sense. Doing something for a decade, it does. I just feel like now it's at the point where I don't know anyone who's done it for a decade and done it publicly. So in that regard, I think that's why I've had renewed confidence to talk about it more. Perhaps that's why we never talked about it enough in the past, is because of that. But now I think it's time to talk about these things a lot more. I think we should do, Andy.
Okay, so that's it. We are done for this week. Don't forget to check out 80/20. You can get a free trial if you so wish. And also, Damien mentioned earlier on in the podcast there about investor biases. We did do a particular podcast that looks at the different investor biases. So if you're new to investing, that's a really interesting video to go and check out. Of course, do make sure that you subscribe and follow the podcast either via YouTube or Spotify would be great. And do make sure you comment as well, because every comment that you post, we see and we do reply to as well. And it helps us with the algorithm. It helps us reach more people. So Damien, all that is left is for us to say until next time.
Until next time.